The stock market's hidden rooms, where the house always wins, even when you do.
The previous video, dear viewer, may have offered the tantalizing illusion that one can outwit the stock market casino by learning its rules and playing intelligently. Commendable, if somewhat naive, aspiration. But what if the very structure of the casino, the unseen mechanics and the silent operators, ensures that the odds are forever tilted, regardless of your personal brilliance? This video will drag you, kicking and screaming if necessary, into the forbidden, hidden rooms of the stock market. We shall expose the arcane machinations, the technological advantages, the psychological warfare employed by the true house, the institutional behemoths, the algorithmic overlords, the informational gatekeepers, ensuring their perpetual dominion over your hard-earned capital. Prepare to discover that even when you win, the system is still taking its cut, subtly, relentlessly, and with a chilling efficiency. This is not about choosing the right stock. It is about understanding the fundamental architecture of your financial servitude.
The Algos and the abyss, high-frequency trading and the invisible hand of speed.
Imagine, if you will, the bustling, cacophonous trading floors of yesteryear. Traders, with their colorful jackets and frantic hand signals, yelling orders across a pit. It was a chaotic ballet, certainly, but one governed by human reaction times, where information flowed at the speed of sound, or perhaps a well-aimed newspaper throw. Now, discard that romanticized image entirely. That world is dead, replaced by an abyss of fiber optic cables, co-located servers, and algorithms that transact faster than a single human neuron can fire. Welcome to the relentless, often brutal, domain of high-frequency trading, or HFT. This is not merely about having a fast internet connection. This is about operating at the very bleeding edge of technological possibility, where milliseconds are not merely precious, but represent vast rivers of profit. HFT firms, these silent, invisible behemoths, employ sophisticated computer programs to execute millions of trades per second, often holding positions for mere fractions of a second. Their goal is not to buy low and sell high in the traditional sense, but rather to exploit infinitesimally small price discrepancies to capture fleeting arbitrage opportunities, and to react to market information before any human being has even had the chance to register its existence. This is the purest form of capitalism, money making money from microseconds, a phenomenon so rapid it feels less like trading and more like a mathematical certainty. How do they achieve this seemingly impossible speed advantage? The answer lies in a financial arms race of epic proportions. A technological marvel built upon strategic infrastructure and astonishing engineering. Firstly, consider colocation. This is not simply having your server in the same city as an exchange. This means physically placing your trading computers inside the same data centers as the exchange's matching engines. We are talking feet, not miles, from the source of the market's heartbeat. This negates virtually all network latency, allowing their algorithms to receive market data and send orders faster than any retail investor can possibly dream. Your meticulously crafted order, painstakingly analyzed and deliberated, has not even traveled the full length of your home internet connection before their machines have already seen it, processed it, and reacted to it. It is a race where you do not even have a starting gun. Then there is dark fiber. Forget your shared internet service provider, your congested lines, and your peak hour slowdowns. HFT firms invest in their own dedicated fiber optic cables, often laid directly between key financial hubs, taking the most geographically direct, shortest possible routes. These are not just fast, they're purpose-built autobahns for data, optimized for absolute minimum latency. They shave off micro-microseconds, turning light speed into a competitive advantage. Imagine the absurdity. Companies paying millions of dollars to blast through mountains or run cables under lakes. It's all to gain a tiny fraction of a second. Why? Because that fraction of a second translates into hundreds of millions, if not billions of dollars in profit. It is a physical manifestation of their insatiable hunger for speed, a chilling testament to the value placed on technological supremacy. The primary mechanism for profit in this hyperspeed realm is often latency arbitrage. This involves identifying tiny price differences for the same asset across different exchanges. Because HFT algorithms receive information and can act faster than others, they can buy on one exchange and sell on another, almost simultaneously, capturing that minuscule spread often before human traders even realize the discrepancy exists. They also engage in strategies such as rebate capture, where they provide liquidity to exchanges and earn a small payment for doing so, accumulating vast sums through sheer volume. This is not some grand, insightful investment. It is a meticulously engineered exploitation of the market's inherent, transient inefficiencies, powered by pure, unadulterated speed. The impact on the individual investor is both profound and subtly insidious. Firstly, it creates an invisible tax on your every transaction. The spreads between the bid and ask prices, the difference between what buyers are willing to pay, sellers are willing to accept, are often controlled by these HFT firms. When you buy, you are paying a fraction more. When you sell, you are receiving a fraction less. These tiny differences, while seemingly insignificant on a single trade, accumulate into colossal profits for the HFT players across millions of daily transactions. You're effectively paying a hidden toll, a tribute to the gods of speed, on every single dollar you commit to the market. Your diligence, your research, your patience, all are subject to this unseen levy. Secondly, HFT can contribute to market volatility. While proponents argue that HFT increases liquidity, critics point to instances where it has exacerbated flash crashes and market instability, as algorithms react in unison to market events, creating rapid, overwhelming surges or drops in trading activity. Your carefully chosen investment, poised for long-term growth, can suddenly be whipsawed by forces you cannot comprehend. It's much less control, driven by machines that respond to data points rather than fundamental value. This is not a conspiracy theory. It is documented reality. The stock market, once a relatively even playing field of human wits and fundamental analysis, has become a digital gladiatorial arena, where the average individual investor is armed with a wooden spoon against opponents wielding nuclear-powered lasers. Your earnest attempt to grow your wealth is commendable, but understand this: you are playing against machines designed by some of the brightest minds on the planet. Machines that operate at speeds beyond human comprehension, using data that reaches them before it reaches you. The house in this hidden room is not a person, but is a network of algorithms, a web of fiber optics, and a relentless pursuit of the nanosecond. And it always has the speed advantage. This reality, dear viewer, is why your perfectly timed trades often feel like shouting into the abyss.
Dark pools and shadow plays, where your orders disappear and profits materialize.
Imagine a grand casino, brightly lit and bustling, where every player can see every wager and every card dealt. This is the image of the stock market that is typically presented to the public, a bastion of transparency and equal opportunity. Now, envision a labyrinth of hidden corridors and soundproofed back rooms within that very same casino, accessible only to a select few, where the biggest bets are placed and settled entirely out of sight of the main floor. These clandestine chambers, dear viewer, are the dark pools, and they represent a significant and often unsettling portion of modern stock market activity. What, precisely, are these dark pools? In essence, they are private exchanges or alternative trading systems where large institutional investors execute trades away from the public eye. Unlike traditional stock exchanges, which display their order books, showing current buy and sell orders to everyone, dark pools keep their order books completely opaque. No one, not even other participants within the dark pool, can see the orders until they are executed. This lack of pre-trade transparency is their defining characteristic, and critically, their most potent weapon. The stated rationale for their existence is naturally cloaked in an aura of market efficiency and investor protection. Proponents argue that dark pools allow large institutional investors, think massive pension funds, mutual funds, or hedge funds, to trade large blocks of shares without impacting the market price before the trade is completed. If a fund wants to buy 1 million shares of a particular company, placing such a colossal order on a public exchange could immediately drive up the price, making their purchase more expensive. By executing in a dark pool, they can, theoretically, get a better average price for their entire order, avoiding the market impact that their sheer size would otherwise cause. This sounds almost benevolent, does it not? A mechanism to protect the interests of large investors, which by extension should benefit all of us whose savings are managed by these very institutions. However, the reality, as is often the case in finance, is far more nuanced and considerably less altruistic. This is where the shadow play truly begins. The lack of transparency in dark pools creates a fundamentally two-tiered market. On one side, you have the public exchanges, where retail investors and smaller participants operate, believing they are engaging with a level playing field. On the other, you have the hidden venues, where the behemoths of finance conduct their most significant transactions, largely beyond scrutiny. This arrangement severely impacts price discovery. In an ideal, transparent market, the true price of a security is determined by the interplay of all visible supply and demand. When a substantial portion of trading volume occurs in the shadows, the prices displayed on public exchanges may not accurately reflect the full market sentiment or actual buying and selling pressure. It is akin to trying to determine the temperature of a vast ocean by only measuring the surface. Crucial currents and depths remain unmeasured, creating a potentially distorted picture. Your careful analysis of a stock's public price may be based on incomplete information, a mere veneer over a more complex, concealed reality. Furthermore, dark pools can facilitate a form of implicit front-running. While not the lightning-fast HFT front-running we discussed previously, institutions using dark pools can avoid revealing their intentions, preventing other market participants from reacting to their large orders. This means they can often execute at a more favorable price than they might have achieved on a public exchange, effectively gaining an advantage that is unavailable to the everyday investor. They are operating in a VIP room where the rules of engagement are different, where their moves remain secret until after the fact, ensuring they get the best seats and the best prices. The implication for the retail investor is clear. You are constantly at an informational disadvantage. You are trading on a public stage where your every small order can potentially be seen, processed, and potentially exploited by faster, larger, and better-informed players, who also have access to the hidden depths of dark pools. Your carefully placed limit order, patiently waiting for a specific price, might be completely bypassed by a massive block trade executed in a dark pool, making your public order irrelevant to the larger price movements. It is an unsettling feeling that your best efforts are constantly being undermined by unseen forces operating with different, more advantageous rules. This system is not accidental. It is a meticulously constructed architecture designed to serve the interests of institutional players, who represent the house in this financial casino. While regulators have attempted to impose some oversight, the inherent opacity of dark pools makes true accountability a formidable challenge. They are a testament to the fact that for all the talk of democratization of finance, significant portions of the market remain firmly in the hands of a powerful few, operating under different rules with different advantages. So, when your research trade does not quite work out, or when the market seems to move against you in inexplicable ways, remember the dark pools. Remember the shadow plays. Your money, while ostensibly traded on public exchanges, is also moving within a system that has hidden rooms, secret passages, and a very distinct hierarchy of privilege. This is not mere conspiracy. It is the deliberate design of a market where transparency is selective, and where the most significant profits often materialize from transactions that disappear from your view. Your belief in a fair and open market is indeed a charming delusion, one that costs you, dear viewer, more than you might ever truly know.
The information asymmetry gap, when your research is their old news.
Let us abandon for a moment the romantic notion of the lone, brilliant investor unearthing a hidden gem. That particular fantasy belongs to a bygone era, perhaps even a work of fiction. Today's reality is a brutal, relentless battle for informational advantage. A chasm so vast it renders the individual's earnest efforts almost tragically quaint. This is the information asymmetry gap, a canyon separating the resources of institutional players from those of the retail investor. Consider the sheer scale of the financial leviathans against whom you compete. While you might dedicate evenings and weekends to studying quarterly reports, these institutions deploy armies of analysts, legions of data scientists, and battalions of quantitative researchers. These are not individuals performing a cursory Google search, These are teams equipped with advanced degrees, specialized software, and proprietary algorithms designed to ingest, process, and analyze colossal volumes of data with an efficiency that far exceeds human capability. Your solitary effort, while commendable, is akin to bringing a single blunt pickaxe to a fully mechanized mining operation. The outcome is not merely predictable, it is predetermined. Their informational advantage begins long before any report hits public channels. Institutions often subscribe to exclusive data feeds, receiving financial news, economic indicators, and even sentiment analysis from social media before it becomes widely disseminated. They have direct, often private, access to management teams through investor calls and conferences, allowing for nuanced interpretations and direct questioning that are simply unavailable to the masses. They employ technologies to track seemingly peripheral, yet highly indicative data points, satellite imagery of factory parking lots to gauge production, credit card transaction data to estimate retail sales, or even shipping manifests to forecast supply chain health. By the time the official earnings report is released to the public, these institutions have likely already built a sophisticated model, made their trades, and begun to price in the implications. Your grand discovery is already ancient history to them, fully discounted and digested. Furthermore, the very act of public disclosure works against the individual. Regulatory bodies mandate that certain information must be released to all market participants simultaneously. This sounds fair, does it not? Yet the moment that information goes public, the institutional algorithms, with their HFT capabilities, instantaneously read, interpret, and react to it. They trade on the news, not minutes or seconds later, but in milliseconds. By the time you read the headline, absorb its meaning, and formulate a trade strategy, the immediate market reaction has already occurred. The profits, if any, from that initial informational arbitrage have already been captured, scooped up by machines acting within human speed and precision. Your informed decision is therefore based on data that has already been acted upon, priced in, and effectively rendered impotent for immediate profit. This creates a perpetually frustrating scenario for the individual investor. You are always playing catch-up. You are handed information that has already been thoroughly vetted, diced, sliced, and monetized by those with superior resources and speed. It is a financial sprint where everyone else has a head start, a rocket-fueled jetpack, and a private highway, while you are left jogging on a muddy track. The humor here, dark as it may be, lies in the earnestness with which individuals cling to the belief that their home-brewed due diligence can meaningfully compete with the institutional juggernauts. Emotional triggers, the constant feeling of being one step behind, the gnawing suspicion that the market knows something you do not, the frustration of seeing a stock move sharply before the news that ostensibly caused it breaks publicly. This is not paranoia. This is the accurate perception of a system fundamentally skewed by informational disparity. It breeds a sense of unfairness, a pervasive feeling that the game is rigged, because in this particular aspect, it absolutely is. So, when you next sit down to conduct your stock market research, remember this gap. Understand that you are not merely seeking information. You're attempting to gain an edge in a domain where the most valuable insights are ephemeral, proprietary, and acted upon with a speed that defies human comprehension. Your research is vital for your understanding and long-term strategy. Yes, but do not mistake it for a tactical weapon in the daily informational skirmishes. For in the hidden rooms of information asymmetry, your freshest insight is, to the powerful, merely old news. It is time to adjust your strategy, dear viewer, because attempting to win on information alone is a battle you are fundamentally destined to lose.
Derivatives of destruction, the leverage traps beneath the surface.
You fancy yourself a shrewd investor, do you not? You understand stocks, perhaps even bonds. You believe you have a grasp on market fundamentals. But then you hear about options, or futures, or, heaven forbid, contracts for difference. The jargon alone can induce a headache, yet the whispers of immense rapid profits are intoxicating. This segment will pull back the curtain on these financial products, exposing their true nature not as mere hedging tools, but as potent amplifiers of speculation and systemic risk, transforming minor market fluctuations into catastrophic losses for the unwary. These are the hidden leverage traps, the financial equivalent of playing with highly volatile chemicals without proper training. What exactly are derivatives? In their simplest form, they are financial contracts whose value is derived from an underlying asset, such as a stock, an index, a commodity, or even an interest rate. They are not the asset itself, but rather a bet on the future price movement of that asset. This concept, initially designed for legitimate hedging purposes, farmers locking in prices for their crops, airlines fixing fuel costs, has been warped into a vast, intricate playground for speculators. And this playground, dear viewer, is paved with the scorched remains of ambitious retail investors. The most insidious aspect of derivatives, and the primary reason for their destructive potential, is leverage. Leverage is the ability to control a large amount of value with a relatively small amount of capital. Imagine you want to bet on a stock. However, where there is leverage, there is amplified risk. If the stock you bet on rises by 10%, your $10,000 investment would yield a $1,000 profit. With the option, that same 10% move can turn your $500 investment into $1,500, a 200% return. This is the intoxicating promise, the emotional trigger that hooks countless individuals. The dream of quick exponential gains is a powerful motivator, often overshadowing any consideration of the downside. But what happens when the underlying asset moves against you? That 10% drop in the stock that would have cost you $1,000 on a direct share purchase can completely wipe out your $500 option investment, resulting in a 100% loss. And for many derivatives, particularly futures and more complex option strategies, your potential loss is not limited to your initial investment. It can extend far beyond, requiring you to deposit additional capital or face a margin call, forcing you to sell at a loss and potentially putting you into debt. This is not merely losing a bet. This is entering a financial black hole. The market, dear viewer, is a master of bait and switch. It presents derivatives as sophisticated tools for the financially savvy. While quietly omitting the fundamental truth, they are inherently designed to amplify risk. The complexity of these instruments makes them difficult for the average person to fully understand, leading to a false sense of security. The language itself is a barrier. It's filled with terms like strike price, expiration, implied volatility, and delta, all of which serve to obscure the brutal simplicity of their underlying mechanism, a highly leveraged bet. Consider the emotional roller coaster. The initial surge of confidence as a trade goes your way, the euphoric belief that you have finally cracked the market's code. Then, the creeping anxiety as the market turns, the desperate hope that it will recover, followed by the crushing despair as your capital evaporates. This is not investing. This is gambling on steroids, a high-stakes game where the probabilities are often opaque. The consequences are immediate and devastating. The casino, through these derivatives, allows you to bet the farm on a single roll of the dice, promising boundless riches, but typically delivering financial ruin. Furthermore, the opaque nature of these instruments means that individual investors often find themselves exposed to risks they do not fully comprehend. Counterparty risk, liquidity risk, model risk, these are not abstract concepts. They are very real dangers that can materialize without warning, turning what appeared to be a well-calculated position into a sudden, unmitigated disaster. The individual investor, enticed by the promise of exponential gains, often finds themselves ensnared in a web of complex mathematics and counterparty risks, leading to swift, brutal, and often incomprehensible financial incineration. So when the siren song of derivatives calls, promising unparalleled wealth and financial freedom, remember the hidden leverage traps. Remember that while the potential for gain is amplified, the potential for catastrophic, capital-obliterating loss is amplified exponentially more. This is not a tool for the timid nor for the uninitiated. This is a game where the house, with its vast resources and intricate understanding of these instruments, consistently profits from the ambition and ignorance of those who dare to play. Your hard-earned money, dear viewer, is far too valuable to be fed into these derivatives of destruction. They are indeed complex, but their purpose for the individual is often simple: to take your money quickly and efficiently.
The psychological chasm. Why your own brain is the house's best ally.
You believe yourself a rational economic actor, do you not? Creature of logic, capable of dispassionate analysis, immune to the base whims of emotion. A charming self-deception, one might say, and precisely the kind of delusion upon which the financial markets thrive. For while the institutions wield speed, secrecy, and superior information, the market's ultimate and perhaps most diabolical weapon is its profound understanding of human psychology. It plays upon your hopes, your fears, your greed, and your desperation with the precision of a master puppeteer, transforming your natural instincts into pathways for its own profit. Let us dissect the various cognitive biases, these delightful quirks of human wiring that relentlessly sabotage your financial decisions. These are not character flaws, mind you. They are evolutionary remnants, hardwired mental shortcuts that, while useful for evading saber-toothed tigers, are catastrophically ill-suited for navigating the volatile currents of a sophisticated financial market. First, consider the fear of missing out, FOMO. FOMO, that tantalizing, excruciating sensation that sweeps through the collective psyche when a stock, or a sector, or an entire asset class is soaring. Everyone else appears to be getting rich effortlessly. The news anchors are giddy, your neighbors are bragging, and the internet is awash with stories of overnight millionaires. Logic dictates that buying into an asset after a parabolic rise is fraught with peril. Yet, the emotional trigger of FOMO, the primal fear of being left behind, of missing out on easy riches, overrides all rational thought. It compels you to jump in at the absolute peak, just as the smarter money is quietly exiting. The market loves FOMO. It is the ultimate sucker magnet, expertly separating you from your capital by appealing to your inherent desire for belonging and prosperity. Then there is loss aversion. Psychologists have definitively shown that the pain of a financial loss is approximately twice as powerful as the pleasure of an equivalent gain. This bias manifests in two destructive ways. Firstly, it makes you prone to holding on to losing investments for far too long. Stock you bought that is now down 30%, you rationalize, you hope, you pray. You refuse to sell because realizing that loss feels like an admission of failure, an unbearable psychological sting. Meanwhile, the market, utterly devoid of sentiment, continues its impartial decline. Secondly, it often causes you to sell winning investments too early. You see a healthy profit, and the urge to lock in that gain to avoid the potential pain of it disappearing becomes overwhelming. You snatch a modest profit, only to watch the stock continue its ascent, leaving you filled with regret and, paradoxically, often triggering a renewed bout of FOMO. Your brain, in its attempt to protect you from pain, ironically ensures a suboptimal outcome. Next, we have confirmation bias. This delightful mental trick causes you to actively seek out, interpret, and remember information that confirms your existing beliefs, while conveniently ignoring or downplaying any contradictory evidence. So, if you believe a certain stock is destined for greatness, you will readily consume articles and analyses that support that view, dismissing any cautionary tales as mere negativity or biased reporting. The market, with its endless stream of opinions and data, provides an ample feeding ground for confirmation bias, allowing you to construct a reality that validates your prior decisions, even when that reality is about to crumble. You are effectively building an echo chamber within your own mind, silencing the very doubts that might save your portfolio. Do not forget anchoring. This bias dictates that your initial exposure to a piece of information, such as the purchase price of a stock, disproportionately influences your subsequent decisions. You anchor to that initial price, believing it to be the true value, and then struggle to adjust your expectations even as market conditions fundamentally change. If you bought a stock at 100 and it drops to 50, you might still view $100 as its rightful price, hoping it will return there, rather than objectively assessing its current value and future prospects. The market preys on this by presenting initial price points that subtly guide your future perceptions, making you a prisoner of your own past investments. Finally, there is herd mentality or social proof. Humans are tribal creatures, hardwired to follow the crowd, to seek safety in numbers. In the market, this translates into an almost irresistible urge to do what everyone else is doing. During bubbles, this means buying into wildly overvalued assets because everyone else is doing it. They cannot all be wrong. During crashes, it means panic selling alongside the masses. It's often at the absolute bottom, because the collective fear becomes contagious. The market, through its creation of trends, its narrative building, and its dissemination of collective sentiment, masterfully harnesses this ancient instinct, guiding you into precisely the same costly errors as millions of your peers. The market, dear viewer, is not some benevolent institution concerned with your financial well-being. It is a vast, complex, adaptive system that has, through decades of evolution, become exquisitely adept at exploiting these inherent human vulnerabilities. It understands your psychology better than you understand it yourself. It generates the narratives, amplifies the sentiments, and creates the conditions that trigger your biases, turning your hopes and anxieties into profit opportunities for those who remain coldly rational, or more accurately, those whose algorithms are entirely free from human emotion. This is the ultimate financial sabotage, orchestrated not by some shadowy cabal, but by the wiring of your own mind. The good news? Awareness is the first step towards liberation. It's recognizing these biases for what they are. Psychological traps allows you to begin developing the discipline, strategies, and the emotional detachment necessary to counter them. Your brain is indeed the house's best ally, but it does not have to be. It is time to reclaim control over your own mental faculties. For in the casino of the stock market, self-awareness is your most potent defense.
The house's last laugh. Why your victories fuel their empire.
Thus, we conclude our illuminating, if somewhat unsettling, tour through the stock market's hidden rooms. You have glimpsed the algorithmic titans that outpace your every thought, the clandestine pools where your orders vanish from sight, and the information arsenals that render your research quaintly irrelevant. You have also observed the intricate traps of leveraged derivatives, and the insidious ways your own psychology is weaponized against your financial well-being. The illusion of a level playing field, where diligent individual effort guarantees proportionate reward, should now be thoroughly shattered. Understand this: the house does not merely hold an advantage, it is the advantage. It is the architecture, the technology, the information flow, and the very psychological landscape within which you operate. Your participation, even when profitable for you in the short term, ultimately contributes to its enduring power. But here's the critical distinction. Knowledge is power, even if that power is primarily defensive. You cannot dismantle the casino overnight, but you can and must refuse to be its unwitting pawn. Arm yourself with this understanding. Question every narrative. Scrutinize every seemingly free service. Now, do not merely absorb these truths, act upon them. If this unvarnished dissection of the market's true nature has sparked even a flicker of critical thought, then it has served its purpose. Prove that you are more than just another data point for the algorithms. Like this video to signify your newfound clarity, comment with your own observations, or perhaps a new hidden room you have discovered. And most importantly, subscribe to Finance Unfiltered to ensure you are never again caught unaware. Share this revelation with every individual who still believes their careful stock picking can consistently beat a system designed to extract value at every turn. Remember, the market does not care about your dreams. It cares about your capital. It is time you understood its game.